Welcome everyone to Macro Hive's week ahead. I'm sitting in for Andrew again. He's off on holiday, likely for him, but don't worry, Dom is still here. Dom, how are you?
Well, thank you. Enjoying the beautiful Southern California fall weather.
Oh, you're very lucky. Here in the UK, it's freezing. It feels like winter's really kicking in. But we should probably concentrate on some of the more interesting stuff for our clients and for our viewers. The past week, sadly, however, there's not really been much. There's not a lot for us to discuss. The data side, the politics side, the Fed side is. Have you spotted anything interesting there that we should be paying attention to?
Not really. I mean, the key appointments for us are really Treasury Secretary and Trade Representative, and nothing definite there. The data, there wasn't much. Some residential real estate data that showed not much change. In terms of Fed speak, the doves were dovish, the hawks were hawkish. So this was really kind of a, down week in terms of news.
So
Next week,
basically, you've been able to relax basically for a week and prepare for the next week.
indeed, to take advantage of this beautiful California weather.
Awesome. So speaking of next week, shall we jump straight into the data? There's quite a lot of big data to come out, and I guess it'd only be fair to concentrate on Wednesday. There's a lot going on. We have PCE, the spending and income data, and the GDP data all within a couple of hours to digest. So shall we dive into each of the data releases and we can go through them one by one?
Sure. So, as you said, the most important one is the personal income spending and PCE price index. So, on the PCE price index, Chair Powell conveniently told us that the Fed expects 2.8% year on year. Month on month, the consensus is 0.3. If you look at the data, the month-on-month core PC consistent with 2.8%. Year-on-year goes from 0.24 to 0.32. It's probably going to be around 0.25 month-on-month. But from the Fed perspective, they are economists like me. They are looking at the big picture. So a few basis points here or there are not going to be to make much of a difference. I want to look at the trend, and the trend is that core PC is stuck in a range. Powell told us it's fine. This is what he said in his last speech, as long as it doesn't move out of the range. So not expecting anything that could change my Fed view here. I'm more interested, perhaps there is more scope for surprise on income and spending. The consensus there implies no increase in real terms. If so, this would be in line with my view that growth is about to slow, largely because the immigration surge ended in the middle of the year. So we will have less of a growth in the number of consumers, as that means slower growth.
And just for people that are unaware, what's happened on the immigration front?
So what's happened on the immigration front is that we had a big surge, something that actually Powell discussed in his last speech in the Q&A. So because it's mostly illegal immigration and asylum parolees, we don't really have a very reliable estimate. We have the CBO estimate 2.6 million in 2022, 3.3 in 2023. Before the administration closed the border mid-year, they thought it could be another 3.3 million this year. So we're talking about very substantial numbers here. And in the Q&A last week, Powell admitted that it raised both potential and actual outputs. And now that this is over, it's going to lead to lower potential and actual outputs.
So is there anything we need to watch for then in the GDP numbers? Will this GDP number be affected, or is it more about the future GDP numbers?
So I think we could already see some signs of that growth slowdown in the GDP. So what we are getting next week is a second estimate of the third quarter GDP. And the first estimate had a very high number for consumption, 3.7%. I mean, the trend in the US for everything is about 2%. And that number was driven by strange things like a big jump in consumption of medicines. And I know that, medicines are expensive in the US, but still. So I think we could see a downward revision in consumption.
And I guess the Fed aren't, I mean, outside of a catastrophic release. So if it was just to come in as you expect, I'm guessing the Fed are just going to take that status quo and part of the sort of the setup and the framework that you like to use for the Fed. I guess they're going to just see this as another number where it says, look, the US consumer domestic demand is still actually pretty robust.
Definitely. Also, the Fed thinks in terms of resource pressure, right? Because it's okay to have fast growth of actual GDP if the growth in potential GDP is also fast. This is what Powell alluded to when he mentioned that both potential and actual GDP went up because of the immigration surge. So they are looking more at measure of resource pressure. So a key one, for instance, is unemployment, which we've seen come down. Another one is perhaps not as obvious because you need a model to estimate it, but it's a so-called output gap, so the difference between potential and output and
And
actual output.
just a question from, I guess, a non-economist here, because we always hear central bankers talk about the output gap. I mean, is it that reliable of an indicator? Do you ever look at output gaps, and when central bankers speak about them, do you ever think, oh, this is worth listening to, or really is it just a bunch of indicators chucked together and it's a fancy model number?
So yes, it is fancy, and I prefer personally the unemployment rate because we live in a services-driven economy, right? So the biggest impediment, the biggest constraint to growth is the availability of workers. And in terms of output gap, well, basically what it is a sort of a fancy average of a past output growth. So you can use a Kalman filter, you can use more sophisticated techniques, but the idea it's a kind of average of past GDP growth data and the difference with actual. And the reference that many people use in the US and in my experience, has proved quite reliable, is the CBO estimate. And the CBO shows that right now we have a positive output gap, which by the way is consistent with other things like a widening of the external deficit. Basically, when demand grows faster than supply, imports increase and the trade deficit gets bigger. And the other thing that's consistent with a positive output gap, of course, is the fact that core PCE has stabilized.
Okay, so I guess if we're on the topic of how the Fed are thinking and sort of how they model things, we can quite nicely jump into the Fed minutes. I believe they're coming out this week. I guess by now we would have known anything new from the Fed board members by this stage. They would have told us any updates. So is there any real juice in the minutes? Are you looking for anything in particular?
Oh, the minutes rarely have anything exciting, but I think they are just going to repeat what the FOMC members have been saying, which is we should not take the December cut as a done deal. And my view personally is that what's going to, because if you look at the inflation data, it's range bound, right? And the Fed is definitely not going to hike. But as Powell told us, they are watching closely to make sure it stays in this range. And I think their strategy is to use something called opportunistic disinflation. So to hope that over the next few years, there will be disinflationary shock hitting the US economy and that it will bring down inflation. But so based on inflation alone, the case for a December cut is not great in my view. They will cut because I'm thinking there will be a big downside surprise in NFP.
So just to clarify for everyone, you believe there's going to be you believe the Fed are going to cut in December, right?
Yes.
And markets from memory are pricing about 50% of our coins for charts.
Yeah.
And so you believe that 50% is basically markets pricing perhaps the Fed incorrectly and they're pricing them just reacting on recent inflation data, or is there more to it?
So I think it's because I'm looking at the labor market differently from the consensus. And in particular, I think that the impact of the hurricanes on NFP has been overestimated. If you look at the claims data, jobless claims data between hurricane and non-hurricane states, you can't see that much impact. And so in my view, the low print we got, which was 12,000 plus 44 workers on strike, which is about 50, 60,000, I actually think it could be close to the trend, because what is happening is that now that the immigration surge has ended, and I cannot tell you how big it was, what we have is the impact of population aging, and this impact is very severe. Before the pandemic, the last CBO projection of NFP for 2025, 2030 was 50K a month. And the CBO is as reliable and conservative as an agency, an independent agency as you can find. And so if you look at NFP this year, it was about 200K average in H1, 150K average in Q3. And then we have this around 50K number for October, including the impact of the strike. So I'm not saying that December is going to be 50K, but that it's more likely than not below 100K.
So I mean, just to clarify that, when I last looked at NFP forecast, so for the next release, we saw, well, at least I saw some estimates over 100K, definitely closer to 200K. So you're saying that there's now, perhaps not at this rate, because there can always be obviously print-to-print volatility, but going forward, the NFP releases should probably be around 50K, or at least definitely below 100K on average.
Yeah, that's my view.
Oh, wow.
Yeah.
And is that what, and just for everyone and for us really to digest then, I mean, how will the Fed take that? I mean, if you said to me a year ago, the NFPs are now going to start printing 50K, but the Fed are perhaps going to be on hold, you'd go, something seems a bit wrong. Is there more to the data that we should be looking at then? Do you believe there's a story then on the unemployment side and say the wages side that's going to stop the Fed from cutting?
So definitely, the 100K is basically a decline in potential output. That basically we have fewer people, not fewer people, but less of a growth in the number of people who work, which means that the speed limit for the economy has gone down. And one reason I think this sub 100K is going to be such a big surprise is that unemployment is going to remain tight, right? Because it's a slower growth in the supply of
So
labor.
it's a labor supply argument rather than a demand side of the argument, is what you're saying.
100%. Yeah. Yeah.
So I mean, it's kind of a crazy concept to think then. I mean, could unemployment at all decrease, or do you just think it sort of stays relatively stable from here on?
If it is a decrease, it's going to be a 10, 20 basis point decrease. The data is noisy. So I would rather talk about a stable unemployment, but a 10 or 20 basis point move is possible given how noisy the data is.
I mean, hopefully people are following that. I mean, that could be quite a move for markets to understand, because I guess it'll be the same as the 12K release when markets reacted to the 12K or the low NFP, but then once they realized that the unemployment side of things and the wages side of things were strong, they sort of fade that move. I guess finishing off next week, we also have the consumer confidence data. Now, from memory, last month saw an unexpected acceleration, but if I remember rightly, you were more interested in some of the subcomponents, right? Am I
So,
right in thinking that?
definitely, I mean, it's hard to relate consumer confidence, whether it's a conference board or the University of Michigan, to a specific hard data. I mean, there is some loose relationship with durables consumption, but in the conference board series, what is interesting is labor market differential. So the difference between the jobs plentiful index and the jobs hard to find. And what's interesting is that in the last release, the index improved. And that's very consistent with my story that there are fewer people available to work. So the labor market is getting tighter. Unemployment fell in August, September. And then last month, we had this increase in the labor differential index. So it's very possible that we could get the same thing this month, which would reinforce people's expectations that NFP are likely to be strong. And so if I'm correct, and we end up with a sub 100K number, this will be even more of a surprise.
So basically, to wrap up, so at least on the labor market side, over the next couple of weeks, you expect the data to broadly say, look, demand's remaining relatively stable for the labor market, but supply is shrinking.
Yeah, I mean, I'm expecting jobless claims to remain roughly constant as a share of the labor force, which will reinforce people's expectations that demand is strong. When I'm thinking that jobless claims are low because there are fewer people in the US who could be claiming unemployment, so that labor supply is actually weak.
Incredible. Now, Dom, you obviously follow the US a lot closer than I do. Have I missed any data? Have I missed any Fed speakers? Anything important coming out in the next week that we should be aware of, or have we covered everything?
Roughly, I mean, we have durable goods, which is in the Bloomberg calendar. But honestly, if you look at the correlation with capital spending, so non-residential investment, it's not that great. The high frequency data that matters more is imports of capital goods. And there it signals that the corporate investment boom is still ongoing. So not a super important number. Then we will have the new home sales, but it's not going to change much. So even if there is a surprise, it's not going to move the needle much in terms of US growth and inflation. No, so I think that's about it.
Amazing. Now, I just realized when we were talking through the middle of that, your claim for the sub 100K NFPs, we were talking about it, but we didn't actually tell anyone where they could read it. So for anyone that is unaware, Dominique did write a great piece on this, and it is on the website for you to all read. Or if you're a client, please get in contact, and we'll happily talk to you about it. Otherwise, thank you everybody for watching. This is the week ahead. Enjoy your week.